right, it is time to break down different terms that you might see on your insurance claim so you can kind of better understand what it is that you're looking at, what does this dollar amount equate to, what does it really mean, and how does it all come together to finish out your claim. And it also helps you understand what to expect in terms of an invoice from the contractor and what you can expect in terms of what the insurance company is actually willing to pay out. So let's dive into that a little bit. The first one is your ACV. The ACV is the actual cash value. That's what it stands for. So the best way that I like to explain the ACV on a policy or on your roof is imagine your roof is worth $20,000 when it's brand new, okay? But that was 10 years ago. And let's say that it has depreciated in value $10,000 over the last 10 years, so 50%. Okay, so at the time of the event, the actual cash value of that product or that roof is depreciated 50% from that 20,000, so it's actually only 10,000. That's what the product that got damaged is worth at the time of the storm. That's essentially your loss. That's what you lost. So the ACV is the actual cash value of that product at the time of the event, determined by age, essentially, is what makes the ACV what it is. So it's that actual cash value. It's what you lost at the time of the event, and the insurance company, that's what they give you a check for, with a caveat. And I'll explain that in a second. But that's what that check is for. Hey, this is your actual loss, so this is what I'm going to give you up front. That's generally in the form of the first check, all right? Next one is the RCV. It stands for Replacement Cost Value. So that would be the actual cost to replace that product in its entirety and make it brand new again. So let's just say that your roof had depreciated 50% from 20,000 to 10,000 over the course of 10 years. The storm event happened, your ACV is 10,000. We just discussed that part. But to bring it back up is another 10,000. $20,000 is your RCV. That's the replacement cost value of a brand new product, brand new roof. That's your RCV, okay? The next one is the DEP, or depreciation. And there's two different types of depreciation here. It's called recoverable and non-recoverable. So that depreciation is how much that depreciated over time, right? It's over these last 10 years, how much, what was that value that it had depreciated based on age? And so that's what DEP, or depreciation, means. Now, like I said, there's two types of depreciation. There's recoverable and there's non-recoverable. And that depends on the policy that you have and sometimes the item or the product that they are evaluating the value for. Recoverable depreciation means that the insurance company is willing to pay you or compensate you for that depreciation that had occurred as long as you actually replace that product. The non-recoverable depreciation means the insurance company is not willing to compensate you for the depreciation of that product over time, even if you do replace that product. Okay? Recoverable, they'll pay you for it. Non-recoverable, you're on your own. Okay? And at the very end, I'll go into how this all ties together. The DED is also the deductible. Okay? The deductible, there has been debate about the deductible for as long as insurance companies have been around. The deductible is the amount of money that you came to an agreement with your insurance company that in the event of a storm, you would be willing to cover. That was your agreement. When you opened up your policy, you sat down with your insurance agent and they figured out all the coverage. They said, okay, if you're willing to cover this much when an event happens, then we'll put your policy premium at this much. If you're willing to cover more, we'll drop your premium. If you're willing to cover less, we'll increase your premiums. It's kind of like this balancing act here. But regardless, it's an amount that you agreed that you would cover in the event of a storm. Now, I'm going to pause there for a second because there's been debate over what that actually means in terms of where does that go, who does that go to, who's responsible for paying that, how is it paid, when is it paid. So when it comes to the deductible, the insurance company doesn't care. They don't care how that money comes out of your account. All they care is that you're responsible for it. okay? You can pay that to whichever contractor you want to that's working on the house. Insurance company does not care. Generally speaking, you can do one of two things. Either one, you can give that to the contractor that's doing the biggest item on your claim. Or two, you can spread it out depending on how big those items are. It doesn't matter as long as the contractors are being paid in full and you are fully covering your own deductible. Now, what's really important to keep in mind here on the deductible, you paying your premiums doesn't count towards your deductible. Okay, you actually physically have to pay your deductible. When your insurance company sends you a check, they're going to say, oh, the ACV amount, which is generally your first check, is $10,000, but they're going to, maybe you have a deductible of $1,000. They're going to send you $9,000. And you're going to say, oh, well, it looks like I paid that already. I've already covered it. I mean, because they sent out less. No, that's how they're ensuring that extra $1,000, which is your deductible, actually comes from you. Okay? That's how they do that. So that deductible is what you agreed that you would cover, that portion of the project that you would cover, that goes to the contractor and it goes out of your bank account. It is not supplemented by the insurance company. It's not covered by the contractor. We as a contractor cannot cover your deductible. It is a felony to do so. I cannot stress that enough. It is a felony for any contractor to cover your deductible. Okay? It's illegal. If the insurance company finds out about it, you don't have insurance anymore. If anybody finds out about it on the contractor side, contractor doesn't have a license anymore. It is not worth risking it to cover your deductible to do you a favor, because it actually doesn't help anybody out. It doesn't help us out at all. So deductible, your responsibility. Okay. Moving on, SUPP, supplement. So the supplement is any item that is on a claim that was missed by the insurance company. And it could be missed for a variety of reasons. Maybe they didn't realize that there was a code upgrade. Maybe they couldn't see what was going on underneath the roof, and therefore they wouldn't have known to include that product on the claim. So, and there could be other things. They could have just flat out missed it. Who knows? But the supplement is something that needs to occur on that roof to bring it up to like new status that the insurance company in their policy agrees to cover, and they just forgot to include it or didn't get a chance to or didn't know to include it on the policy. And again, that's where a good contractor comes into play, because they need to be able to recognize that. They need to know the difference between what's a supplement and what is something that has to get done, but the insurance company actually isn't responsible for doing it. And there's a little bit of a gray line there. But a good contractor is going to be able to sit down with you, go over your policy, go over your claim, and let you know, hey, this item is supplemented. We're going to go after your insurance for it. Don't usually have any issue getting that covered. Usually permits, things like that. Maybe drip edge if it's required, or ice and water shield if it's required, but it wasn't there prior. That falls under something else though, in case if they didn't miss it, or if it's something that yes, this needs to get done, but unfortunately, your insurance company is probably not going to cover it. And that's things like crickets, maybe. And cricket is just a structure that you build onto the roof to help divert water around a vertical surface. Not always is the insurance company going to cover that. Think of things like the house was built a certain way, and maybe the climate's changed just enough where we get a little bit more rain, and now the way that house or that roof was built, it's not conducive to withstanding that much rain or snow buildup or something like that. Well, that's not really the insurance's responsibility. That's how it was built. And you might think, you should cover and bring it up to code, but that's not, they're not at fault for something being built incorrectly in the past. So that's knowing the difference between what is a supplement and what the insurance does agree to cover versus what's not their responsibility. The last one down here is PWI. That means paid when incurred. Those are items that the insurance company has recognized you do need this, and we are willing to cover it once you get it on there, but you don't currently have it on your roof, so we're only going to pay it out when you prove to us that you did it. Those are things like code upgrades, like drip edge and ice and water shield, things like that, where the insurance company knows it has to go up there, but they're like, well, you don't currently have it, so we can't depreciate anything, we can't valuate it right now. So tell you what, we're gonna put this arbitrary number next to it and say this is what we think it's worth, but you're not gonna actually get that unless you do the work. So that's called PWI, or paid when incurred. And on an insurance claim, you're going to see maybe a grayed out line item or a crossed out line item. Those are paid when incurred. That doesn't mean that the insurance company saw it, put it on there, and then just like, no, we changed our mind, we took it off. No, that just says that, hey, you don't currently have it, we know you need it, prove that you actually did it, and then we'll pay it out. Okay? So how does this all play together then? So if you look down here, we've got ACV minus deductible equals first check. So that's how the insurance company can ensure that you pay your deductible. Your ACV amount, they take off your deductible from what they're willing to pay you, and then that's how they make sure that you actually pay your deductible. Okay? So let's say, again, we're going back to that first example. The value of the roof was $20,000. It depreciated 50% over the last 10 years. Storm hit, ACV amount is $10,000, your deductible is $1,000. That first check coming to you is going to be $9,000. Okay, it's going to be the $10,000 minus the $1,000 your deductible, and that's going to be that first check that you get. Okay, the next one, deductible plus your ACV, which is your first check, plus the depreciation equals the RCV. So once we get the actual work done, you can add up the ACV, the actual cash value, and the deductible that you're responsible for, and the amount that it depreciated over time, and you get the replacement cost value of that product when you go to get the work done. Okay. Now, oftentimes, depreciation alone will be your second check that you get from the insurance company after the contractor has invoiced the insurance company. That depreciation amount is going to be your second check, and it's going to be the recoverable depreciation that is on that second check. The non-recoverable depreciation you won't see. You can't even argue for it. They've already determined it's not recoverable. Okay, so that second check will be your recoverable depreciation once the contractor has proven to the insurance company that the work is completed. And then down here at the very bottom, these are if there's supplements and if there's paid when incurred items, then the depreciation plus the supplements plus the PWI is going to be the second check or additional checks. There are times where the insurance company will release the depreciation on that second check, and then they might follow that up with a third check that includes PWI and then a supplement or a combination thereof. So that's all the terms, the main terms that are related to your insurance claim. You got your ACV, you got your depreciation, you got your deductible, and you got your RCV, your supplements, your PWIs, and all of that should be something that your contractor can sit down with you and discuss in further detail if you have any questions about it.